So when it comes to money, bad advice spreads fast, especially when it sounds good. But the problem is a lot of financial advice is just flat out wrong, and believing it could be costing you thousands of dollars. So today, we're going to bust 17 common money myths. Let's go ahead and dive in. Number one, carrying a balance on your credit card helps your credit score. No, carrying a balance does not help your credit score. In fact, it actually could hurt your score and cost you an interest. What actually helps your credit score when you look at the FICO score determinations, keeping your balance low, paying it off in full regularly every single month, these are things that actually help your credit score, and it shows lenders that you're being responsible and not reliant on credit. So saying that you need to keep a balance on your credit card to help your credit score is like saying it's good to eat junk food right now so that when I go on a diet in a month, I'll lose even more weight. No, that doesn't make sense at all. Number two, it's best to wait for a dip in the market to invest. I hear this all the time, and it sounds really great. But timing the market in reality often means that you're going to miss out on the best days. Time in the market beats timing the market. The longer your money is invested, the more compound growth goes to work in your favor. And when you wait, that often means you miss out. And lots of research and different studies have shown, statistically speaking, the best time to invest is always right now instead of waiting for a future dip. Because if you're waiting for a 5% pullback in the market, but the market grows 20% before the next time that it drops 5%, you've lost out. That doesn't end up being a good strategy. And in fact, we've seen this many different times, but really from 2010 to 2020 was a great example because many investors stayed in cash or in more conservative investments because they feared the quote unquote double dip recession after 2008. We're going to go into another recession, so wait. But every year they waited, the market kept rising. And if they had invested money back in 2009 or 2010, that would have really grown into something instead of waiting and waiting and waiting for the perfect entry point. Number three, buying a home is always better than renting. No, not always. Renting can offer more flexibility and it has fewer hidden costs. With home ownership, you can build wealth over time by the home appreciating in value and you gradually paying down the mortgage. But all along the way, you're going to be paying taxes, you're going to be paying for maintenance, and you're going to be paying for insurance. The longer you stay in one place, the more likely it becomes that home ownership is the better way to go. But for shorter stays, 5 years or less, renting is often cheaper. You can go back to episode 177 where I talked about home ownership is overrated for a deeper breakdown on this. Number four, gold is the safest investment. Now, gold historically has always held value, but it is not foolproof and it is not immune to volatility. It doesn't generate income like stocks or real estate or bonds. And it can go through very long periods of flat returns. You look at how gold did from 1980 all the way to 2006, 2007, not great. Even though recently gold has shot up, there have been long periods of time where gold has been down or flatlined. Also, investing in physical gold does carry its own very real safety risk. Diversification is always a better safety net than putting all of your trust in gold. Gold has been just as volatile as stocks historically, and when you look at the long-term real returns, stocks and real estate have actually outpaced gold. Number five, budgeting is for people who are bad with money. A lot of people believe this, but it's actually the opposite. What I found is that people who are good with money are the ones who are more likely to use a budget because it helps them to stay good with money. Budgeting is just simply a plan. It's something that helps you to tell your money where to go. And budgeting isn't a punishment. It's not something that you've been banished to for being bad with money. It's a way to ensure that your money is going to the things that are actually most important to you. Number six, if I make more money, then I won't need a budget anymore. This piggybacks right off of number five here. Earning more without a plan for what to do with that money just means you're going to end up spending more. There's something called lifestyle creep, where the higher your income goes, the more stuff and the more spending you find to fill in that place. A bigger income makes budgeting just that much more important, is what it does. And it allows you to allocate more money to things that actually build wealth and freedom. So budgeting properly understood is not something you want to run away from. It's actually something that you want to embrace. Number seven, if you can afford the monthly payment, it means you can afford the item. Monthly payments do not tell the full story, not anywhere close. Just because something fits your monthly cash flow doesn't mean it fits your financial priorities. You have to look at total cost. You have to look at interest. You have to look at the long-term impact more than just, hey, can I swing this payment? And you just ask a car salesperson, most people will think in terms of a monthly payment instead of their actual total cost. Most people would never want to plunk down $70,000 today for something that's going to be worth $20,000 7 years from now, but they will find a lot of ways to justify a $1,000 a month payment so they can drive the car of their dreams now. Number 8, getting a tax refund is a good thing. Well, getting a big refund certainly feels nice, but what it means is that you probably gave the government an interest-free loan last year. Ideally, your goal would be to break even. That means you neither owe too much nor did you overpay the government. That puts more cash in your hands throughout the year. So if you paid $8,000 in taxes last year and then got a $4,000 refund, now that feels good because the way we often work is that we mentally account for that money and say, oh great, this is money that I'll use to pay off my debt or to take a vacation. But in reality, what this means is that you could have had over $300 a month more in your paycheck last year, but instead you let the IRS hold on to that for you for several months. Number 9, I deserve this so I can afford it. Now, you may deserve a break or a treat, and certainly every now and then you should treat yourself. But deserve and afford are different things. Affording something means that it fits your plan, that it doesn't hurt your future goals, and it doesn't require you going into debt to finance it. It's amazing the mental gymnastics that we'll go through to justify our poor financial moves. Instead, what we should do is flip it around. What can I afford? Start with that. And out of that list, then I can choose something that is appropriate to reward myself. So you may have just gone through a crazy busy season at work and you're looking to take some time off and enjoy yourself. Okay, well maybe you can't afford a Caribbean cruise, but you can afford to go see your favorite team or your favorite artist, and that's going to be a much better way to treat yourself. Number 10, you need a college degree to make good money. Now, this was never true to begin with, but even more so now. There are so many avenues to a good income. Trade, tech, entrepreneurship, more paths than ever to high income without having a college degree. Now, I am not anti-college degree. In fact, a college degree can be immensely valuable, but it is not a guaranteed ticket to success, and it is not the only way. Research shows that college graduates are far more likely to be financially successful. When you look at people with high income, proportionately, most of them would be people that have a college degree, but that is because the highest paying careers are the ones that typically require higher education, medicine, engineering, law, etc. But college education doesn't give you the things that are most valuable in life. Work ethic, character, and ability to spot opportunity. Those will serve you much better. Number 11, debt is a part of life. You're always going to have payments. Here's the thing. Now more than it has been in the last few years, it feels more impossible to get through life and to accomplish your goals without going into debt. But you can live debt-free. Many, many people do. Debt might feel normal in our culture, but normal isn't always wise. With intentional planning and some delayed gratification, it would be possible to break that cycle. What I've seen is that many times people just grow up in either families or communities where debt is very normalized. Everybody has payments. And so when those people are then old enough to make their own financial decisions, they just copy what they've always seen. But delayed gratification and hard work, it is possible to build wealth without needing to take on lots of debt, especially early in life. Number 12, married couples should keep their finances separate. All right, call me old-fashioned, but if you are going to commit to somebody in marriage, that means being willing to go all in. Marriage is something that is built on trust, and if you are keeping finances separate, you're communicating that your spouse cannot be trusted with one of the most important aspects of your life. And what this usually does is it creates more confusion and secrecy. Marriage is a partnership, and money should be part of that partnership. That's what I firmly believe. Separate accounts might work for organizational purposes, but separate mindsets and separate ownerships usually don't. Instead of it being your money and my money, it needs to be, hey, we are a team and this is our money. Number 13, a stable job with good benefits is safer than starting a business. I have to strongly disagree as a business owner myself, and I can see how a lot of people would push back on this. But a job is not as safe as people think it is. A job can disappear pretty quickly with a layoff, with a downsizing, with a bankruptcy. Now, owning a business certainly has risk, but it also gives you control and earning upside. The real safety is having a strong skill set and the ability to adapt. That's what is safe, not just relying on one company for your paycheck or for your benefits. In a traditional job, somebody else is setting your schedule, they're limiting your earning potential, they're determining how valuable your work is, and that's a ceiling that is very difficult to break through. What sounds better to you? Someone who promises to give you food and water every day, but you have to trust them to deliver it, or planting your own farm and digging your own well? Number 14, you can't lose money in real estate. It always goes up. Wrong. Real estate definitely can go down. Ask anybody who bought some real estate in 2007. Markets fluctuate. Bad tenants exist. Properties come with costs, unexpected costs sometimes. Real estate can be a great investment. Absolutely. But it is not foolproof. You just look at a lot of metro areas that have seen big run-ups in their real estate market only to collapse years later. We can look at Detroit, Buffalo, Phoenix, Vegas, Miami. Many, many examples exist. Real estate historically has risen in value over the long term, but it is not as quote-unquote guaranteed as some people think it is. Number 15, Bitcoin or gold is the only safe haven. No single asset is the safe haven. Even Bitcoin, gold, whatever other asset you want to put into that can crash. So don't buy the hype. Don't think that just because something has done really well for the last few years and this person that you follow on social media, they always have these really slick charts and cherry-picked data that show me that Bitcoin or gold is always the safe haven. A well-diversified portfolio where you're investing in different types of assets is far safer than betting on any one thing to save the day. Number 16, investing in a life insurance policy is the secret wealth building strategy of the rich. Let me just tell you something right now. Most wealthy people have made their money in business, real estate, and or stocks, not life insurance. Permanent life insurance can be useful in sort of niche situations, but it is not the secret sauce for building wealth. It is, however, the secret sauce for life insurance salespeople to confuse you with jargon and financial concepts that you don't understand and get you to buy an expensive policy that you probably don't need. Number 17, Roth IRAs are better than traditional IRAs. Not always. I think more often than not, Roth IRAs are going to be a better way to go for most people. Roth IRAs are great because if you expect to be in a higher tax bracket later, you can go ahead and put money in a Roth IRA and have tax-free money later. But a traditional IRA can be better if you need the tax break now or if you're going to be in a lower tax bracket later. The right choice is going to depend on your current and future tax situation. So the truth is, most of these money myths survive because they sound good, but they don't hold up under the scrutiny of real life. So if you want to build lasting wealth, you need wisdom, not just conventional wisdom. Don't just settle for what everyone says. Dig deeper, ask questions, and make decisions based on the facts. So thanks for listening. I'll catch you on the next episode.